Hi, this is Chuck, better known as Low Trade. Yesterday I did a 6-month long-term chart on a stock called Pacific Gold, symbol pcfg. Uh, Within that chart I evaluated a OTC uh, chart pattern which I called Run Retrace Channel Pattern. And I also utilized the my fibs overlay to determine breakout targets once that pattern broke out. Uh, Tonight I want to go over a 3-month chart, which is a short-term chart, and evaluate the bottom bounce within this same stock. I'm going to go over, this is going to be a fairly involved evaluation so that people new to the board will see my swing trade indicators that I use, and also cover this little discussion on the bottom bounce play itself. Um, Before I start, I constantly talk about the fibs overlay, the fibs retrace indicator overlay, and at time from time I'll post how to get to it, but now I have a chart so I can show you how to get to it. Within stock charts, when you go to a Java chart or a flash chart, you'll get a chart that looks just like this come up. And right up on the top, you'll see these horizontal lines. That's your fibs retrace overlay that I keep talking about. And how you use it is you just click on it, you come down to the start of any run that you want to evaluate, and you click where the run starts. You drag up to the top body candle of the chart and you release. And once you release, then you have your fibs overlay. So this will give you indications of your support levels, your three main support levels as this thing retraces. And this is where the rule of thumb for retracement comes in handy. At any rate, now you know where it's at when I keep talking about it, and how to find it and implement it on a chart. But let's get back to what I want to go over tonight. Um, on this chart, I have my favorite indicators. I use 4 indicators for a short-term swing trade. The first ones would be, there are 2 used to determine an entry-exit point, and there are 2 used for support of that decision. The DMI is on the top, and that's called a directional movement indicator. Many books and charts will call it the ADX, but I don't call it the ADX because the ADX is the average of the 2 indicators. The actual indicator indicates trend, okay? And the ADX indicates the strength of the trend. It is not the indicator. It's just the strength. But at any rate, they're wrong and I'm right. Okay, let's go over. The directional movement indicator will tell you 2 things. It'll tell you when to expect a change in trend, and it'll tell you when it confirms that trend change should continue. Now, how you get your early indication is when one, either the DMI plus crosses over the DMI minus, or in a negative trend, DMI minus crosses over the DMI plus. And how you will get a confirmation that this reversal in trend is going to continue is when your ADX turns and moves in the same upward direction as the trend indicator on top. So let me show you what I'm talking about. Back here in this area, you can see that finally the negative ADX crossed above the positive, telling you that the trend has reversed. Okay. Now, there is no real confirmation within the ADX line, the black ADX line, telling you that that trend reversal is going to continue. Okay. Until back around this point. This point is when the ADX line confirmed that the downtrend is going to continue. As you can see, it started turning up. As you can see, the negative trend is active. And if you go down at the chart and look at what happened with the price, you will see that there is an early signal telling you exit, but it was not confirmed back here. Okay, you will see here where the ADX turns up and confirms, that is where that it actually broke out and continued down. So this is just a risk level decision. If you have a higher risk and you see a trend reversal and you want to jump in on that trend reversal, you're more than welcome to do it. If you have a lower risk trading style, normally I would recommend, and this is what I do, is I would wait for a confirmation that that negative trend is going to continue. So if you were shorting this stock because I'm going over a negative trend here. But you can see down here within the chart, okay, you should have exit down here. You're getting your early indication that that you're getting your exit signal, but as you see, it's just stalled. It's just flat. It's not going anywhere until confirmation was seen up here in your entry exit indicator. Now we'll move down and we'll go over the second indicator I use, which is a 510 moving 510-20 moving averages. They'll give you the same indication, and they'll give you a be in and be out state like the DMI. You want to be out when it's trending down, and you want to be in when it's trending up. Well, down here, if you look at your 5, 10, and 20, if they're lined up in order with the 5 on top, the 10 below that, and the 20 below that, then you should be in the stock. If they're lined up opposite with the 20 on top, then the 10, then the 5, then you should be out of the stock. So that's fairly obvious. And it will also, this overlay will also give you an early entry and a confirmed entry indication. That occurs when your 5 crosses your 10 and your 10 crosses your 20. Your early entry or exit is when the 5, well, let's look down here. When the 5-day crosses the 10-day, you have an early entry indicator. And when the 10-day crosses the 20-day, you have a confirmed entry indicator. Okay, now support indicators. These indicators, your entry exit indicators, are going to give you points that you can evaluate depending on your risk level when trend changes and when to buy the stock. Now, to confirm or to aid you in making this entry decision or exit decision, I use the support indicators below, which are the Scotch RSI, which is basically a combination of the stochastics oscillator and your RSI relative strength indicator, and your CMF, which is your money flow indicator. I like it because it has a zero line and it will actually show you pressure, buy pressure, or sell pressure, and that in turn tells you how interested retail is within this stock move. With your Scotch RSI, there is, as I said, it's an oscillator. There is a zero. It's a 0.5 line. It's a center line, and some people will use this as an entry indication or an exit indication. When it crosses above, it's okay to enter the stock. When it crosses below the 5 line, it's okay to leave the stock. But confirmed being gotta be in the stock or gotta be out of the stock is your 8 and your 2 line. If you're above the 8 line, you should be in the stock. And if you're below the 2 line, you should be out of the stock. So I use this more as a support to my decision for entry with the entry exit indicators above. Now, down below with your CMF, buy pressure, sell pressure, what this is telling me is that, what does retail think about this move? Okay, the stronger the buy pressure, the stronger the interest of retail behind this move continuing. So it's said that anything above 2.5 is very strong buy pressure or very strong interest. Anything below 2.5 is very strong sell pressure or very bad retail feelings about the stock. It's also said that point 1 is your weak indication. Anything below point 1 is weak pressure. Anything between 0.1 and 2.5 is average, and anything above 2.5 is above. So now you know how these various indicators that I use work and what they tell me and what they should be telling you. Okay, let's go back to the bottom play, the bottom bounce play. I've done a video about bottom bounce plays, and I'll include the link with this post so you can cover that. But within the bottom bounce play, there are several things that are used to determine the momentum of the move on a comeback. First, resistance levels will slow or stall the continued move, and gaps, on the other hand, will be little tugs or little pulls, pulling the price up, pulling the continuation to keep it moving. So whenever I do a bottom bounce evaluation, I always lay out my resistance points and my gap points so I can know what's pulling and what's stopping. As you can see here, during the retrace, emotion gaps happened at various levels. There was a gap down here, which was a motion gap. There was a gap from here to here one morning, and there was a gap from here to here one morning, and there was a gap from here to here one morning. So this has had emotional gaps down, which with common gaps, 90% of the time, if you watch them, they're going to end up being filled. Well, it just so happens if you look at this chart, 90% of the time has occurred again. They all eventually got filled. 90% of common gaps get filled. You can trade that alone. You don't have to have anything else. You can just go out and trade gaps if you want to. But at any rate, I always lay the lines out and do an evaluation because every time it starts moving up, you can expect a stall at a resistance point, and you can expect continuation at a gap point, to the gap point. And as you can see how she progresses up. So we got our bottom bounce play covered. We got what we use in our bottom bounce to determine whether it's going to be pulled up next or whether it's going to be held back next. All bottom bounce plays, I say, you should never enter a bottom bounce play because no one can call a bottom until first resistance is crossed. First resistance is crucial in entering a bottom bounce play. You can always get faked out if you enter too early. So back on the 6-month chart, the run retrace channel pattern that I did earlier, I gave the board on move this stock to strong watch back on the 19th, and that was because first resistance in the bottom bounce was broken. Now, I wasn't giving that entry to play the bottom. I was given that entry to play the overall long-term trade, which was a run retrace channel pattern all the way up to previous high, which is at 8 cents. But it just so happens if you evaluate the bottom bounce in itself, it's giving you the same indication. Any bottom bounce play from the start, you evaluate your resistance levels going up, and you got to expect that the bottom bounce is everyone's going to be happy with the stock, and the comeback is going to bring it all the way back to where it belongs. It just so happens in this stock, pcfg, if you take the long 6-month look and the short 3-month look, both indications are calling for a target of 8 cents. So this is good. Within the bottom bounce play, once you cross your last resistance, okay, you're wide open from this point up. As you can see in this chart, last resistance was broken yesterday. Yesterday was the day that I went back to the board and told them an early entry signal has occurred, and you should move it from strong watch to possible entry if you're a higher risk trader. Uh, Once we'll go down and we'll cover the support indicators at this point. As you can see, the entry exit indicators continue to give you positive and positive, and down on your support, as you can see, the Scotch RSI is still telling you be in this stock, and at this point you can see that there is strong buying pressure way over 2.5. The retail herd is moving into this stock, and everyone's happy with this comeback. All resistance to slow this move down has been broken, and your black candle gap up is ending up finishing towards the high of the day. So even though the day tried to pull it back down, it still ended up towards the high of the day. So overall, I would say it's pretty safe to be in this play, and if you do get into this play, you can expect the possibility of an overall target of 8 cents. I guess that's about it for tonight. Uh, this is Chuck. I'm signing off. I hope you've learned something about the various indicators that I use, what the indicators tell you, how they can aid you with decision making, and also help you with determining risk levels within your decisions. Good night.